Today's live stream on X from Interactive Brokers. I'm Andrew Wilkinson, Director of Trading Education. Jose, how are you? Our Senior Economist down in Florida. How you doing, mate?
Andrew, doing well. How are you? Don't forget, not just X, also on LinkedIn and YouTube. So really can find us anywhere this morning live.
Indeed. And Jose, it's an interesting morning. Hints that President Trump wants to end the war have sent the stock markets north, and I think coupled with positive comments from Fed Reserve Chair Jerome Powell yesterday about the one-off nature of inflation stemming from the Liberation Day tariffs on the U.S. economy, there seems to be a sense of better things ahead. What do the markets look like?
Yeah, well, Andrew, markets got really pessimistic. We almost reached a 10% drawdown level on the S&P 500 yesterday at right above 6,300. So natural that we bounce from there. A lot of stocks, when you look under the hood, particularly in some of the most popular stocks, like in the Magnificent Seven names, some of those shares are down over 20% from their highs. So effectively in bear markets. So there's quite a bit of pessimism baked in there. Of course, all the major benchmarks are now in the red year to date, which is disappointing considering that at the beginning of the year we were expecting a cyclical reacceleration that drove the Russell 2000 and the Dow Jones into a pretty sizable lead against the S&P and the Nasdaq to start the year. We expected a cyclical reacceleration alongside a few rate cuts. Now, however, the focus has shifted to the potential for downside risks to growth. So a decelerating economy, perhaps, alongside a Fed that's more or less steady. And at times throughout this Iran conflict, there have been episodes where folks have started to price in Fed hikes as early as this year. However, like you said, Chair Powell yesterday did downplay the potential inflationary impacts from the oil shock in the Middle East. However, we'll have to wait and see. Other central bankers have been more cautious, like in the ECB. They're geared up to hike maybe twice or three times this year. Their inflation came in this morning for March. It was 2.5%, really sizable leap from the 1.9% we saw back in February. UK, similar dynamic. Australia already hiked a few times. Japan was already hiking. So it looks like from a global central bank perspective, we were in the pause to cut camp. However, now we're moving more into like the pause or hike camp.
So we've got a couple of pieces of economic news coming out in this shortened Easter week. What's really driving the markets at this point? We're going to talk in a minute about the Conference Board Consumer Confidence Index coming out at 10 o'clock, but also up on Thursday. On Friday we've got the February jobs report. Right? How do things look from your seat?
So we will be closed Friday, but there is that jobs report that's coming out. Yeah, I mean, hiring has been slowing down significantly. There is concerns that because of the uncertainty from the Middle Eastern war alongside the lift in borrowing costs, that's going to really weigh on more roster additions. So the labor market could cool even further. And that's what a lot of the doves in the Federal Reserve have been talking about, why it's probably time to cut sooner rather than later. They've been saying that for a few months now. As far as the consumer here is really in a negative place because we've had a K-shaped consumer where a lot of the higher income shoppers have been driving more and more of the consumption. And that's really been driven by robust capital markets gains, not just in stocks, but also in fixed income. However, this year we're facing losses in both of those asset classes so far, and that threatens to really slow down the spending from those upper income cohorts. Meanwhile, the lower and middle income cohorts, they've really been now faced with this new pressure of lofty gasoline prices, which is a direct opposite of the goal of the Trump administration from the beginning last year, which was to have subdued energy costs. If a lot of you folks Remember the mantra, drill, baby, drill. The idea was you were going to have heavy production, mild regulations, and that was going to keep gasoline prices in check. And it did for most of last year and the beginning of this year. However, now with this conflict, the pain at the pump, also the pain with electricity, and less relevant now, heating, those costs also really lowering the capacity for consumers to spend in other areas like in discretionary services or in consumer staples, etc. Airlines have really been, a key driver as to how this story can shape out, because their revenues are being pressured by a consumer that's having reduced capacity, but their costs are also a lot higher, of course, because of jet fuel. So really seeing initial stories of compressing margins in some areas on Wall Street. And that's why certain stocks are getting battered pretty hard. Also, remember this year, AI enthusiasm has begun to fade in 2026 after 3 years of spectacular outperformance. Shifting back to the economy, however, I think the number one variable I'm watching, and a lot of us are, is really crude oil prices. Headlines have repeatedly come out on either side. President Trump either dialing up his hostility or turning more into a deal man, into ceasefire posture, depending on the day. But really, oil gives us that clear indication of what's actually happening on the ground. So in a day like today, you'd expect, maybe because of the headlines and because of stocks and rates performing well, treasuries and equities gaining. Of course, treasuries gain when yields drop. You would expect maybe that oil is down a lot. Well, oil is still at $103, down only $2, despite the progress that equity and fixed income investors see. And Andrew, that's been something that we've been continuously experiencing throughout this last 5 weeks or so with this Iran war starting, is that certain markets view things differently. Sometimes the equity markets are more optimistic about the war. Other times treasuries are more pessimistic. Commodity traders have their own view, etc. So that's been interesting to see the bifurcation across asset classes.
Yeah, indeed. We've got West Texas crude at about 103 and Brent crude up at about 118, so $15 on the spread there between the two of them. And on Truth Social this morning, President Trump told the Europeans to go and get their own. If they want jet oil, come and buy it from the US because there's plenty. And at the same time, just go and take the oil if you want it from the Straits of Hormuz. So how does the energy narrative play into today's consumer confidence numbers, Jose?
Oh, I mean, really clear direct impact. There's two things. A lot of the old timers say there's two things that the consumers care about the most, and it's the gasoline prices and stock prices. Why? Because it's a direct relevant figure. Like, when the S&P's at 6,500 or 6,300 or 6,100 or 7,000, same way when gas is $4.50, $4, $3.50. So it's really those clear direct signals that really affect consumer psyche, and really work into the whole psychological impact of higher prices. But then also, of course, business opportunities and jobs. That's also a big driver. But those, the job market has been strong, relatively speaking, when you look at certain aspects like the unemployment rate and layoffs. But then other aspects like the hiring rate and the pace of payroll additions, those have been pretty disappointing. And consumers, Andrew, really have been focusing more on the weaker aspects of the labor market rather than the stronger. And continuing claims have dropped quite significantly, but they remain pretty steady for a long time, really signaling the dynamic where we have not a lot of layoffs, but also companies aren't out there rapidly expanding their workforces either, and consumer confidence is out, folks.
Well, we were expecting 88 after, which would have been a drop from 91.2. Just shout out as soon as you have the number, Jose.
91.8. So we got a pretty big beat and an improvement from February, which is pretty odd. You'd expect that we'd have a weaker number, and that was the forecast. But let's we'll look under the hood to see what's driving that beat. And while we do that, maybe we go to Steve to showcase our forecast trader.
Certainly.
Hi, I'm Steve Sosnick, Chief Strategist at Interactive Brokers. Where do you think inflation is going? Do you see a recession ahead or more growth on the horizon? What's your prediction for the Fed funds rate? Right now, 73% of traders expect it below 4% in December. What's your forecast? Interactive Brokers forecast contracts let you turn insights into action. Buy a yes or no contract on ForecastTrader and earn $1 for each correct prediction. We invite you to explore the data, spot the trends, and make your call. Start forecasting today at ibkr.com/forecast. The best informed investors choose Interactive Brokers.
I don't know about you, Jose, but I'm seeing the Conference Board's website down.
Me too, and that's why we're going to go straight to our forecast trader. And really, this has been the shocker so far this year, folks. The Republicans, their probabilities in the Senate to maintain their majority at the beginning of the year, folks, was up at around 75%. Today, that's down to 54%, almost a coin flip. Really a direct influencer to that has been the pain at the pump, as well as volatility in the stock market. But then also traditionally, once you have the conclusion of a presidential election, you do tend to have a little bit of a swing the other way during the midterm. So it does make sense that the Democrats should have somewhat of an advantage in these midterm elections. But the House is essentially 85, 86%, 83% right now. So pretty much in the hands of the Democrats, unless something changes in short order. And then in the Senate, we have a 50-50 race. That's, since when the war started at the end of February, beginning of March, we were up at 60%. So clearly the public here, turning away from the party in power, at least in the short term, looking for an alternative.
So in terms of the prediction markets, Jose, what are we looking for in terms of the employment report to come out Friday?
Yeah, let's navigate over there to our market section, economic indicators, labor, United States, U.S. payroll employment. So when we look at the March number north of 80,000 is at 32%. A number below 30,000 or below is at 28%. So looking for a number here between 30,000 and 80,000 for non-farm payrolls in the month of March. That's out this Friday. And the unemployment rate, we're looking for that to come in between 4.3% and 4.5%, 21% chance of a number higher than 4.5, and a 22% chance of a number that doesn't exceed 4.3. So 4.3% or under for the unemployment rate.
And what about Thursday's initial claims numbers? How are you seeing the granular data? You don't necessarily have to show that on the prediction market, but how's the granular data feel to you?
Yeah, the granular data feels like it's pretty stable. When we look at what's going on with continuing claims and with initial claims, really at that low end, initial claims has been around 210,000 for 5 or 6 weeks or so. Really well below the danger levels. 240 historically are numbers where you want to start to worry. And then continuing claims made I want to say a 22-month low last week, so the lowest in almost 2 years. That was, volatile numbers, but still very encouraging, because for a long time, folks that were looking for labor market deterioration were waiting to see a potential spike in continuing claims north of 1.9 million, maybe towards 2 million or more, but that hasn't manifested yet. However, Andrew, since you asked about granularity, the jobs have been really all about healthcare the past 2 years or so. Really haven't had much buoyancy from the other areas. Part of it is demographics. We have a closed border, of course, that hampers the potential growth in construction, manufacturing, agriculture, leisure and hospitality, amongst other sectors. Then you have rates that are still too high for manufacturing, construction, and small business to feel comfortable expanding headcounts materially. And then you have the AI effects. There's been concerns around the more youthful prospective workers that they're having more trouble getting into firms, stepping in right after college. And a lot of that has been blamed on AI. And then finally, there's also been a factor that folks say that some firms are essentially using AI as a justification to get rid of workers that they really didn't want or they wanted to get rid of anyway. So there's also some of that going on. And of course, throughout sectors, we have some periods where they're weaker than others. So some areas of the economy, they want to get rid of some workers sometimes and lower their costs.
The requested service is temporary, unavailable, is either overloaded or under maintenance. Please try later. So I'm not seeing anything in the in the Wall Street Journal either. So I think everybody's been deprived of today's conference board report, Jose.
Yeah, everyone's been deprived, but we got a beat. Better than expected. Who knows why? I guess we'll cover it next time in our April reports. We'll be covering the CPI, PPI, and retail sales. Anything else you want to talk about, Andrew, before we go?
No. So I think great Easter to everybody. But you're going to be there 8:30 on Friday morning, just writing this one up, right?
Just considering that we're going to be closed, I'll be writing it on my notepad. And my computer will be closed because I won't. I don't think my colleagues will be around. However, if they will be around, let me know.
Very good. All right, Jose, thanks for joining us today. The markets look solid. They look solid beforehand and afterhand. Equity prices are up about 2%, continuing with the rebound. I think there's a lot of people thinking this is the war news has provided this similar opportunity as to Liberation Day did a year ago. What took your what happened yesterday, Jose? I was shocked to find that the stock markets were up.
Yesterday, yesterday we closed red yesterday. We closed red yesterday. We had a little bit of a little wobbly.
Yeah.
I think it's folks still reconciling whether the war is going to be over or not, and to what extent it'll be over. And then you have another really significant thing. I don't think it's getting much attention. Yields in oil have started trading in different directions.
Yeah.
You started to see when oil shot up yesterday and Friday, Andrew, you saw yields fall hard. And that's a meaningful turn because that means that fixed income investors are now increasingly worried about the economic growth backdrop rather than inflation, right? Why would you?
It took Jerome Powell to say that.
Jerome Powell's statements did have an impact too, but that was afterwards. I think today we're getting follow through on rates because of what Powell said. That the central banks, at least in the U.S., isn't going to be as hawkish on oil cost inflation. So that gave rates a reprieve, at least dismissed the idea that we'll get a hike this year. But overall, we've been seeing mounting recession risk too. In our ForecastTrader, in our Interactive Brokers prediction market. Whoops, I think I left for a moment. Sorry about that. In our Interactive Brokers prediction markets, we are seeing that there's rising recession risk. So recession risk is up to 40%. And now fixed income investors are starting to wake up to the fact that, hey, forget about inflation. If oil stays this high for so long, we're going to have an economic slowdown on our hands. So that's been a critical shift in this Middle Eastern conflict story. And of course, President Trump wants to bolster markets to improve the Republican Party's odds in the midterms.
Yeah, so a bit of a confusing picture. I think it's informative this morning that the markets didn't. That there was no further decline in consumer confidence. We'll have to wait and see what the inside numbers are. But I think for now the story is continued rebound in equities.
Do we want to talk about consumer confidence? The website is up now, folks.
Sure.
We're still here. Put on my glasses.
All right. Edged up a little bit by 0.8 points from 91 in February. Present situation increased by 4.6. Expectations, short-term outlook, declined by 1.7 points.
Yeah, in the present situation, really driven by better business conditions and perceptions of employment conditions improving. So that's really the index. It's really made up of two indexes, the present and the future. So the present got better because of better business conditions and improved employment opportunities. Then expectations came down due to perceptions of future labor market conditions, as well as future income and business possibilities that were lackluster. So we had a bifurcation here.
Yeah. Although the overriding comment from Dana Peterson, the chief economist at the conference board, was, nonetheless, the index has been on a general downward trend since 2021. So not out of the woods, but at least it's not a leg lower. There's a little bit of stability there.
Yeah. And you had buying plans for autos continued rising. Home buying expectations declined somewhat. As far as
a clear tick up in inflation expectations over the next 12 months.
Recession anticipations rose. Percentage of consumers thought that interest rates over the next 12 months would increase. That moved up from 34.9 to 42.4. And expectations for higher stock prices actually declined. So consumers here more bearish on treasuries and on stocks. But that could be recency bias just because of a tough month in both asset classes. Folks are just feeling a little rough maybe when when the conference board called them and they looked at their portfolios 5 minutes before, they were maybe a little bit under the weather and reflected that in the survey.
Yeah. All right, let's leave it there, Jose. And what's the next topic we're going to come back to?
Consumer price index. That'll we'll have the dates published for you later, folks. CPI, PPI, and retail sales. That'll be in Spanish. Thanks to our tech team, Andrea Brown. Now we have Leora Jones. She's also on our tech team. So thanks so much for supporting us this morning. And Andrew, of course, thanks so much.
Brilliant. Jose, and to the listeners, have a wonderful long weekend if you are off on Friday. And we'll speak to you soon. We look forward to your write-up on the conference board later on, Jose, which you'll find on Traders Insight.